In June 2019, the United States recorded its longest continuous economic expansion in history. Gross domestic product posted steady aggregate growth, and major stock market indices repeatedly cleared record highs. However, the benefits of that growth were concentrated exclusively in a specific segment of population. This chart compares the expansion's aggregate growth with its distributional reality. Between 2010 and 2019, the real wealth of the top 10% of households grew by 19%. Over that same decade, the real wealth of the bottom 50% flatlined, remaining below its pre-crisis levels. This suggests that the recovery was a statistical mirage for most of the country. The physical evidence of this fragility was widespread. By 2019, 37% of Americans reported they could not cover a $400 unexpected expense, and overall income inequality had surpassed the levels recorded during the Great Depression. The mathematical timing of this divergence suggests that these wealth curves were a direct output of post-2008 financial policy. The Federal Reserve calls its primary strategy the wealth effect. In practice, this framework operates as a compounding force designed to push asset prices higher. This engine is powered by two distinct monetary levers: quantitative easing and zero interest rate policy. The Fed's expanding footprint made the Eccles building the primary driver of national wealth distribution, often overriding the effects of fiscal law. These policies engineered a structural transfer of wealth to existing asset holders, while suppressing the mechanisms of capital formation for wage earners. In quantitative easing, the central bank extracted trillions in secure assets from the market, replacing them with cash reserves. This asset scarcity removed safe yields. Seeking returns, capital flooded into equities, inflating stock valuations independently of economic growth. The distributional impact of this inflation depends entirely on who owns those equity assets. Federal Reserve data shows that 86.5% of all household stock ownership is held by the wealthiest 10%. Because equity ownership is so concentrated, quantitative easing functioned as a multi-trillion-dollar structural subsidy to the wealthiest balance sheets. While the wealthy benefited from asset inflation, the zero interest rate policy, or ZIRP, had the opposite effect on the working class. By driving real interest rates below zero, the policy inverted the historical relationship between debtors and creditors. Historically, saving $2,000 annually at 5% grew to $50,000. Post-2008, zero interest rates collapsed that curve, leaving savers with barely $30,000. These low rates erased $2.4 trillion in compounding yield from U.S. savings. Middle-class savers lost their nest eggs, while leveraged investors used those near-zero rates to borrow cheaply, using that cheap debt to heavily amplify their returns in the stock market. ZIRP penalizes the primary wealth-building tool of the working class, while mathematically subsidizing the leverage of the wealthy. The third variable in the inequality engine is the shift in bank regulation following the financial crisis. Under new capital requirements, regulators mandated that shareholder equity backstop consumer lending, drastically increasing loan origination costs. Banks responded by abandoning low to moderate income loans, where regulatory costs erased profits. Instead, liquidity diverted into channels with lower regulatory burdens: Fed reserves, corporate buybacks, and high net worth wealth management. This regulatory asymmetry froze credit access for the middle class, while funneling institutional liquidity back into the financialized sector. This integrated model shows how quantitative easing, ZIRP, and capital requirements collectively govern the flow of capital. Tuning these three specific valves directly dictates the slope of these diverging wealth curves. While analysts often focus on taxation or education reform, these fiscal changes are slow. They struggle to outpace the compounding, daily force of a monetary engine that reallocates capital at this scale. The responsibility for managing this environment rests with the leadership of the Federal Reserve. Restoring shared prosperity requires a complete dismantling of the wealth effect mandate. This means normalizing interest rates to restore a living return on deposits, shrinking the Fed's portfolio, and realigning regulation to incentivize real economy lending. The mechanics of money creation and the rules of regulatory capital allocation exert more force on modern wealth distribution than the tax code itself.